Good evening. On behalf of the Ascension Parish Library, I thank you all for joining us for the second session of creating a financial scoreboard using numbers to build a better business. Your mics have all been muted to avoid background noise, and also we will begin the recorded session. Right now, I am pleased to present today's guest speaker, Ms. Bonita Rice. And Ms. Bonita Rice has over 20 years of corporate experience working with C-level executives in several roles: asset management, management analyst, and project management. Tonight, we will host the second session of creating a financial scoreboard using numbers to build a better business. So now, please help me in welcoming Ms. Bonita Rice.
Thank you. Thank you very much. I guess I should take my mask off now, everyone. Okay, thank you so much. Thanks for joining us this evening this is our second session for creating a financial scoreboard, how you can make your company profitable. Well, what we're looking at today is what strategies can we implement to assess whether or not our business are profitable. And once you're able to see whether or not you're profitable, what is the next step that you can do? Okay, so the first session recording is currently available. HTTPS at the Ascension Public Library Business Resource Center. And you can click on this link, or you can go to the Ascension Public Library, click on their Business Resource Center tab, and have access to the webinar. Not just the first webinars, but all of the webinars as they come up. So this is the second webinar. You'll have access to that one. And then you'll have access to the third webinar, and eventually the last and final webinar. Today, we're going to focus again on identifying 3 critical positions that must be filled by employees. We're not going to go into details. What we're really going to do is review what we talked about last week. We talked about making sure you have a good bookkeeper and a great accountant, because the numbers are so important. The decisions that you have to make are so critical that if your numbers aren't correct, you will not be making decisions based upon good information. The other position that we talked about that was critical is having good management. And when we talked about having good management, we're not saying that the owner of the company must be the manager. We're saying that the owner of the company must hire a great manager, someone who has people skills, who has integrity, who has organizational skills, someone who will be able to motivate, someone who will be able to understand what his role is, not flirt with the employees, and all those things. So those are the things that we're looking for when we talk about having good management. And we also mentioned, of course, that you need to have human resources, a good person who will manage your employees, not from the perspective of managing the business, but managing the employees, making sure all of your paperwork's submitted, making sure that your employees understand what their functions are, making sure they understand how they're being evaluated. So we refer to those things as the human resources. And what we talked about was the fact that just like you would not want to have to stand on a one-legged stool, you would not want your business to operate only on one person, one premise, just one leg. Because of course, a stool on one leg will not stay standing. So you need at least 3 legs to 4 legs to make sure that your stool remains strong, it's standing, it can hold its weight, whatever you put on it, it's gonna hold it, it's gonna balance. The other part of it is that we want to make sure that the information that you are using is correct. We talked about that. But what we talked about was why it was important to have good information. And the reason why it's important for us to have good information is because you can't make decisions on bad information. So we talked about the financial statements. I mentioned to you that there was three different statements that makes up the financial statement. You have the profit and loss, which talks about the transactions that occur in your business, the balance sheet that only shows you a picture of where your business is at, your financial reports are at a particular point in time, and that is the point upon which you print it or the date that you set. And then we talked about the cash flow, which is really the most accurate picture of your cash. It will show you exactly where your cash came from. It will show you exactly how you spent your cash, whether it was to pay for operating costs, whether it was to pay for financing or obtain financing, or whether you use your cash for investment. So the cash flow is a critical part of your financial statement. And if you're not getting a cash flow statement, you really don't know what you spend your money on. And just to rehash, the reason why that cash flow statement is so much different than the profit and loss statement is that the things on your profit and loss statement are expenses you incurred, not necessarily expenses you paid. Okay. However, the things on your balance sheet shows you what you owe and what you own. So again, we're not really necessarily seeing what you've paid for on your balance sheet. But when you look at your cash flow statement, you get to see what you're using your money for. Are you paying down bills? Are you just buying cars? Are you buying inventory? How did you get the cash? Did you get your cash from your sales? Did you get your cash from an investment? Did you get your cash from the bank through the use of financing? So those are the things that we talked about last week. And so now this week, we're going to examine some critical ratios that's going to make your business more profitable. So again, let's go back over the financial statement. We said there are three parts. The balance sheet provides information on your business as of the date that you run it. It's a snapshot of your assets and your liabilities and your net worth. Truth of the matter is because you have a snapshot of your assets and liabilities and you did a great job managing both your assets and your liabilities, which is why you would have a net worth. A net worth is not something that you create. It is something that you have as a result of managing your assets and your liabilities properly. Again, the balance sheet is always going to report as of the date you run it. A lot of people run a balance sheet at the end of the year, sometimes at the end of the month. A balance sheet doesn't necessarily tell you what you have in your bank account, and neither does your bank account tell you necessarily what cash you have available to be used, okay? The balance sheet is just simply a report, and your bank statement is just simply a report. It just tells you what's in your account. It doesn't tell you what you have available to spend. You have to do something more with it. Income statement reports on your business ability to generate money. So it's showing you where you get your money from. That's in the revenue section. The biggest issue a lot of people have is that they don't categorize their revenue. They take all the money they receive and they say, this is revenue, they put it there. So if you have several different types of operations, you may have operations part of your operations might be to repair rooftops. Another part might be consulting. You may be really good at helping other people to decide how they want to put the rooftop together. That's a consulting fee. You may do interior work, interior renovation. That's another way in which you make money. You may do carpet repairs or carpet installation. You may also have a division that actually builds a home, or another one that renovates the whole home. These are all segments of revenue. A lot of times people don't track their revenue by segment. They just throw it all in a big pot and they say, this is how much money we make. The truth is you have to track your money by segments so that you can see where you're making money, which one of these activities is generating the most money. And at the same time, you want to see which one of these activities is also taking more money from you. Maybe you might be good at interior modeling, but the cost of just doing the interior modeling may be so much higher that you're not seeing a profit, that you may have to either examine your cost, examine your selling price, or you may have to say, well, you know what, maybe this is not a profitable venture, me doing interior remodeling. But the reason why those things are important, because the income statement has to be set up so that it can track all of the ways you make money, so that you can go in and see how you're making money. Likewise, your expense section of the profit and loss should have sub-accounts that relates directly to those revenue account that says, okay, these are the costs that I incurred while generating the sales or the revenue from this particular activity. Okay, so if you've done all that, you can see your profit, your loss. You can say, overall, my loss is not an issue dealing with, my loss is not the issue dealing with my entire business. My loss comes from a particular segment of my business. And once you're able to conduct this level of review, or be able to see this level of information on your financial statement, you're going to do really well moving into the next section. Again, cash flow is all about the Benjamins. I say that all the time. It was a wonderful song, but it's just a truthful song. You know, it's all about how you spend your money, where you get it from, who you got to pay back. That's what the cash flow statement is all about. Did you get a loan or give a loan? Did you buy a building? If you bought a building, are you renting part of it? Did you buy equipment? Did you buy stuff? Those are investments. Operations. Are you buying or selling goods and services? Those are all parts of operations. So now that we have went over last week's presentation, we're going to talk today about this week's presentation, which is using the financial statement values to measure the goal. We covered part of it last week, and last week we focused on comparative analysis. And for those who miss it, comparative analysis is comparing two different periods of time. It could be this month to last month. It could be this year to last year. It could be this year, January, February, March, the first quarter, to last year, first quarter. It could be this year's January, February, March, first quarter, to April, May, June, second quarter. But those are the things that we're supposed to be comparing. And the reason why we do comparative analysis is so that we can see, so that we can examine the difference between each of those periods. You're supposed to be writing down, not guessing, not thinking about it. You're supposed to be writing down, making notes about the events that took place in all of those periods. Whatever you're comparing, you're supposed to be making notes, so that when you look back over the statement for the previous year, you're able to see what was different that previous year, what was different that previous year from this current year. So that is very critical. That's what comparative analysis does. It gives you something to compare against. You know, we compare against ourselves against so many people and so many things. Well, we need to do the same for our business, because that's what's going to help us to make money. Another analysis that we looked at was trend analysis, and that is comparing our values over time. So we're not comparing periods, we're comparing time. So we may be trending our sales in January. We have total revenue for January, February, March, April, May, June, July, August, all the way to December. We're not necessarily adding them up. We're just having January figures on one bucket. February is another. March is another. And when we take each of those totals for each month, and we examine them, we look at them, we trend them, we put them on a bar chart, we put them on a trending line, when we look at it, we can say, okay, did our revenues grow in March? Did our revenues drop suddenly in September? And one of the examples that I used was that here in New Orleans, we have Essence, and Essence is a big thing. Essence is a super huge thing. And 4 million more people descend upon New Orleans. It's filled with excitement, pageantry, music. I mean, it is the showstopper. Well, from a restaurant point of view, my example was a restaurant is looking forward to having all these people come and they're going to purchase all the menu items. And so they go out and they make these huge orders. They try to order everything that they could possibly sell. What they needed to do, had they been doing this before, is that they needed to look at their menu and say, okay, let's look at our menu this month, July, because Essence is around July. Is it July or June? July. Okay, anyway, it doesn't matter. Let's assume that Essence is around the 4th of July, which it actually is, okay? We're gonna look at the 4th of July weekend, just that weekend area from maybe a week before 4th of July, 2 weeks after 4th of July. And we're gonna compare it with the same timeline last year, okay? And maybe the year before that. And we're gonna look for certain things. Now, if you were collecting data on multiple levels, here's what you'll learn. If you were tracking to see which menu item was being sold the most during that time, you'd be able to see if it's a consistent. So if it was consistent, meaning in 2019, we sold a lot of crab etouffee. And we did the same thing in 2018 and the same thing in 2017. So that means management will know that they need to buy a lot more crab etouffee or have more of that in the prepping stage because it's going to sell. Now, at the same time, they may be thinking red beans and rice going to be the hit. And so they go out and they'll buy all this red beans and rice. And at the end of the whole season, they still got red beans and rice. They have enough red beans and rice to take them into December. However, they never studied to see whether or not people's buying red beans and rice. They just assume that this is New Orleans, red beans and rice will be the meal of the day, and it's not. These are the things that trend analysis tells us. So when you're studying trend, you can study from several levels. You can study from the level of how much money you made in this period of time. Then you can break it down some more if you're in a restaurant industry, and you can say, okay, what meals sold the most? What was the top? If I sell 15 items in my restaurant, which 5 sold the most and which 5 sold the least? Maybe I need to get rid of the least, okay? If I take the top 5 and they use similar ingredients, and I'm saying, wow, during this period of time, I spend a lot of money buying this ingredient. Well, that is leverage. So now you take that information that you have and you call your supplier and you say, listen, man, you know, there's 6 of you selling crab, okay? And I want the best deal I can get. And I'm willing to give you all my business if you decrease your cost. And when you tell them, they say, well, how much business is that? You say, well, you know what? I bought 10 million crabs from you. And I'm exaggerating, but it is possible down here. I bought 10 million crabs from you. And I need a break. So you normally sell me a crab for $5 per crab. Okay, how about you knock some prices off and I'll buy all 10 millions from you for $4. $4 times $10 million. 10 million crabs. That's a lot of money, right? That's how you get a competitive this is how you use your financial statement to get a competitive edge, to increase your buying strength and your buying power. So now not only are you minimizing or shrinking your purchasing and just focusing on certain food items that will be sold, the ones that are going to be more profitable. Now, you're also going to your supplier and you're getting a cost savings from them. To me, that's a win-win all the way. You think so? I'd love to hear it, but it's definitely a win-win all the way. So now this month, this time we're really into session 2, and it says, got money, but are you profitable? Everybody wants to know that they're making money. I'm sorry, you're in business to make money, not to do favors, not to make other people feel good. I know you started the business because you know your heart and soul is in it. But honestly, let's get to the heart and soul of the matter. The real thing is you're in business to make money, okay? Not just sell, but to have money left over to put into your bank account for future purposes, to invest in your company so that your company can grow, so you can expand your business. That's what you're in. You're in business to make money for you. Okay? Let's say it again. You're in business to make money for you. So some of the questions that you're looking at is, can your company generate a profit? Is your company generating a profit? If it's not, can your company generate a profit? Maybe somebody's got to look over your books and help you find out where the leakage is at. Okay? That's what that question is asking. Okay? Is can your company generate a profit? What it's not saying, and its indirect question is here is how can we make your company generate a profit? The other question is, how efficient is your company at generating a profit and providing a value for its customer? Let's go back to the restaurant example where I said that they needed to study what was being sold. Okay? That's efficiency. They need to negotiate on the cost of the crab because they buy so much during that short period of time. That's efficiency. Okay. Now that you've reduced your menu and you've reduced the cost of your crab, and now you have all these people lining up, how can we make food, the process of serving the food, getting the clients into the table and out of your restaurant as happy people? How can you do that? That's efficiency. So your company has to get efficient at generating a profit, and everything you do in a company has an impact on the profit, and it has an impact on providing a value for you as its owner. Okay, and it also offers your clients, your customers, to see a perceived value in visiting your entity and doing business with you. So the question is, how do you measure up against other companies in your industry and at your revenue side? Are you comparing yourself, to the other person? Sometimes we compare the wrong thing. Sometimes we look at their cars and say, oh, how does this person driving a BMW? Or sometimes you look at their boat, or you look at their shoes and you look at what they're wearing. You're comparing the wrong thing. The only thing you should be comparing yourself to with another company is revenue. How many employees do we have? How much money are we earning? Are we efficient doing what we do? What is this company doing that's better than what we're doing? What are they doing to grow? What are they doing to have more revenue? Those are some of the things you got to measure yourself up against, not so that you get jealous, so that you can do it better. That's what that SWOT analysis is about. And I'm not going to go into details about the SWOT. All I want to say, SWOT stands for strength, weakness, opportunities, and threat. When you're looking to see how you measure up against other companies, you need to do it from a SWOT analysis perspective. And then you compare your size to their size, meaning your revenue and your employee and what you're doing. And then you can see what they're doing that, again, they're doing better than you, and what you're doing that you can do better or have been doing better than they are. And that's how you check to see what decisions you can make to be profitable. Okay. The other question is, how does your company measure up against itself when compared to the past? So that's, again, the comparative analysis we talked about 2 slides back. That is this. That's what we're talking about. How does your company measure up against itself when compared to the past? It's okay to compare yourself to other people, but you need to compare your company's state, financial state, um, your company's inventory state, let me just say that with inventory state. You need to compare all these different factors of all these different aspects of your company's growth to where you were last year to see if you're doing any better or if you're doing any worse. Question is, are you there yet? Is your company profitable? So some more tools we can use to determine whether or not your company is profitable is really and truly not the balance sheet. It's really and truly not the financial statement. It's really and truly not your cash flow. Those are things in the past. What we're looking at is the things that are happening right now. That's what we're looking at. What's happening right now? That will let me know whether or not your company is profitable. So there's a bunch of ratios that you can look at. In the interest of time, I will not go through all of these ratios. However, the ones that I've identified and highlighted, I'll either go into details or I will mention it and let you know this is what it's measuring. And of course, I provided you with the names of these ratios. And the internet has been a phenomenal tool for everyone, especially for me, because coming from where I came from, we actually used the encyclopedias when we were doing research. Now I can get research done at the speed of light. It's a wonderful thing. So I'm going to encourage you to refer to the internet, do a search on these topics if you need some more information. But I'm going to, in the meantime, go through several of them and break them down a little bit more for you so that you can understand what they are and how to create one for yourself. So my favorite is the burn rate. Nobody ever talks about the burn rate. And I learned about the burn rate while watching a UK roundtable on money. And I just stumbled on it accidentally, but I'm a person who have these abstract thoughts and just inquisitive. I'm an inquisitive person when it comes to business and money. Both of my parents were business owners. My uncles are all business owners. My siblings are business owners. My grandfather was a business owner. He's passed away now. So it's sort of like a gene running our family where we grow up sleeping, eating, making decisions based upon business. I'll give you a joke. At least it's a joke for me now, but when I was a kid, it wasn't a joke. So here's how it goes in my household. I go to my dad and I say, Dad, I need some money. And he'll tell me, well, how much money do you need? And I said, well, Dad, I need some money because I want to go hang out with my friends there. And he said, well, you know what? Well, you have to, no, he asked me, he said, what date is the date you're going to hang out with your friends? And I'll say, well, it's Saturday night. And he looked at his clock and look at his calendar. He said, well, you have to work on Saturday night. Right. And in the back of my mind, I'm thinking, when did I sign up to work on a Saturday night? But he would tell me I had to work every time I asked him to do if I can have some money. So immediately now you understand work and money goes hand in hand. You want some money, you have to work. So then I figured it out. I said, okay, if I have to work to get money, it's been over a year. The employees are getting paid. I need a raise. So I go to my dad and I make sure I keep my distance. Okay, not gonna get too close because I know I'm walking on thin ice. So I said, Dad, I need a raise. And my dad's looking at me like, you need a raise? It's like, oh, Jesus, what made her think she needs a raise? And then so now he pulls out the bank statement, okay? The bank statement from the bank. He pulls out the bank statement. He tells me, have a seat. And he said, this is the bank statement that the bank sends me. In this bank statement, it tells me how my money's been spent. And I need you to reconcile it. Huh. I'm still in high school. I just started taking my accounting class because it's an option in high school to take accounting. And so I just started taking accounting class, finally get a hang of what an asset and liabilities is and all that kind of stuff about the equation. And he said, you have to balance this balance sheet. So here I am. I'm asking for a raise and I got to go work for this raise because I have to balance the balance sheet. I didn't do a good job at it. I really did not do a good job at it. But I learned something as I went along, because when the accountant came in, now she had to show me how to balance the balance sheet because I needed that to get a raise. All right, a raise. So the other time I told my dad, I said, we had a scheduling problem. Let's say we had a human resource problem. And that was, I was out of high school and I wanted to go out and have fun with my friends. My friends was all going out on a Saturday night and a Sunday. But we had a human resource problem because every time I said, Dad, I want to go out, he said, you got to work. I'm like, work? Yeah, you got to work. I'm like, but I worked every afternoon after school. And when I left my job, after I finished high school, when I left my other job, I came here and worked. What do you mean I still got to work? So I thought about it and I said, okay, this supermarket's open 7 days a week. It's closed on Saturdays during the day, open up on Saturday night. And we have a different crew on Sunday. I said, okay, I'm gonna get my break. So I go to the employees who were working Saturday during the day. He had brought on some new employees. And I said, let me tell you, this is how it's gonna work. I know you like going to church Sunday mornings. And I like to sleep in or go out on Saturday night. So we're gonna make this shift flexible. You work this week Sunday morning, I work next week Sunday morning, and you work the Sunday night. And so we broke it up, okay? So come Sunday, I got it. Supermarket closed down for like a siesta about 3 in the afternoons and open back up about 7. And at 3 in the afternoons, I'd get dressed, get my bathing suit, my towel, everything, and my change of clothes because there is no way in the world I'm coming home till the party was over. Yes, I was a party animal, okay? And I had to plan it. And that's how I solved the human resource problem of being able to allocate my time properly to my dad's life, my work life, and my party life. There you go. I shared something with you. So let's get back to the burn rate. Okay, the burn rate is the rate at which a company is spending its capital to finance overhead before it generates positive cash from its operation. That's a lot. The burn rate is important for people who are starting a business. Most of you come in and you're like, I'm starting this business and I'm going to, what's the word they use? It's not piggyback. You're going to carry it all on the weight of your expenses. So you pull out your 401k, you put a second mortgage on your house, you do all these things and you have maybe $100,000, $200,000 worth in cash, and you are convinced that you're going to make this business profitable with that $200,000 cash. And before you know it, guess what? The business is not profitable. You're running out of money. You're in the hole. Your credit is jacked up. You're discouraged and you don't know what to do. The burn rate is telling us two things. The rate is telling us the speed at which you're losing money. But burning through cash is the action. That is the action, okay? And you are burning through your personal cash to finance this business with no hindsight. You know, you have no concept of when you'll be able to begin to generate a positive cash flow from your operations. And so the burn rate is the percentage at which you're burning up your own money. That's summarizing it, okay? It's the percentage at which you're burning up your own money. So how do you calculate the burn rate? You take the total amount of money that you spent last month and you subtract it from the total amount of money that you spent this month. The difference between the two is divided by the total amount of money you spent last month. Now, every time you hear rate and ratio in accounting, that means you have to come up with a percent. And as the laws of percent says, if you want to get to a percent, you have to multiply it by 100 so that you convert it into a percentage, okay? So if you spent, let's give a good example. If you spent $100 last month, okay, and you spent $200 this month, spending more, right? Then you divide the difference, which is 100, by the amount you spent last month, which was 100. So now you have 1. You're going to multiply it by 100, and then you have a percentage of 100. That means you spent 100% of your capital, your personal money, to finance your business without it even generating a positive cash flow. What would be the solution to this? OPM, other people's money. That's very important solution. When you're starting a business, while your credit is great, while you have collateral available, while you have equity in your business, in your homes, while you have everything together, you're good with your bills and everything. While you have that, when you're thinking about starting a business, the first thing you need to start doing is shopping around for a line of credit and or a loan. Line of credit and or loan. And you want to structure it as much as you can to be in your business. So it takes a bit of planning. You want to start planning on how to develop, how to begin creating business credit. And you want to start creating that business credit so that when you get to the point where you say, okay, I'm ready to go out and open my doors and start my business, you have enough business credit where you can go and try and get a loan, a line of credit in the business name. And then from there, you still have your assets. You can still collateralize them, but the cash that you're burning, it will definitely be through your business and from your business. So the burn rate is the rate at which you can spend your capital, your money, to finance your overhead. Your overhead is like electricity, payroll, the rent of your building, your gasoline, all the costs just to keep your business going. That's your overhead. And so let's go back over. The burn rate is the rate at which a company is spending its cash, its own personal cash, you're the owner, personal cash, to finance the expenses, the overhead, the expenses that you have to run this business before generating a positive cash flow. Sometimes it's years. That's why you have to do OPM, other people's money, okay, in order to not burn through all of your cash flow as quickly. Just to go over it real quick, a line of credit versus a loan. A line of credit is simply a line of credit, meaning that you have the bank has authorized you to have 10, 20, 30, sometimes millions of dollars, sometimes hundreds of thousands of dollars. But the bank has authorized this much of a credit line for you where you can transact business from. So you may use the credit line to go buy a computer or several computers. But as you're making your money, you pay it back. You may use your credit line to buy inventory. And we're going to talk about inventory, or we maybe have talked about inventory already, but we're going to talk about inventory and how it's really and truly not so current of an asset. But let's go back. So you're going to use your credit line, your line of credit, to purchase inventory, or you're going to use your line of credit to meet payroll. The key thing is, every time you get cash, you need to pay that line of credit down so that you can have that line of credit available for even more bigger purchase as things go along, as times go along. And the bank will love it too. So now when the bank sees that you're being responsible, you're paying it down as quickly as you can, then the bank will be, honestly, the bank will probably give you more money. because you're being responsible. So that's the whole thing about the line of credit. A loan is one fixed money. Whether or not you pay it down or not, you're not getting any more. So what that means is if you go get a loan for $100,000 and you only use 50 and you paid $50,000, guess what? That's all of the loan that you're going to use. You can't go back and say, I'm going to use the other $50,000. That's just not how it works. Once you use it, it's done. So let's talk about quick ratios. Quick ratio is a measurement of your company's ability to meet short-term debt with its most liquid asset. Your most liquid asset is anything that you can get rid of quickly. And your number one most liquid asset is cash. Oh yes, it goes really quickly. You can leave your house with $5,000 or $10,000 and you can literally come back home with nothing and ask yourself what you spend it on. Same thing for 100. It doesn't matter how much cash you have. It's liquid. It goes quickly. $1, $5, $20, $20,000. If you leave your house with that much money to go spend, it is a liquid asset. It will be spent. Okay? It's a current asset. It's a liquid asset. So the quick ratio really and truly measures how quickly you can pay your short-term debt with your most liquid asset, which is cash or current, and well, they say current inventory, but the truth of the matter is you're going to notice that we're going to take inventory out because nobody's going to buy your inventory quickly. Okay, if you ever notice, the one thing dollars remain in the stores when the stores close down is not the cash, it's the inventory is still sitting there. So quick ratio measures your company ability to meet a short-term debt with its most liquid assets. So if you look at the asset and liability section of the balance sheet that I provided you with, and let me put this up here, you'll notice that we have assets at one point on one side, all current assets. On the other side, we have current liabilities. Now your cash is only $2,100. Petty cash is $100. So now you only have $2,200 in cash. But look at all the things on the liability side. What do they say? They all end in able. Doesn't mean that you're able to pay. It just means that it's payable, meaning that you have to pay. You're payable. So your notes, the loans that you have in the bank, anything that's due within the next 12 months, that's payable. Accounts payable, those are your vendors' account. You may have an account with a supplier of electrical products. That's an accounts payable. Wage payable. You know, when you have employees working for you, you plan to have them there all month or all year, you have to put a payable in your liability. That's a reminder for you that you owe these employees. Those are called wages payable. In addition to those wages that you owe the employees, it includes the taxes that you have to pay the government. FUTA, SUTA, FICA, all these different wonderful taxes that the government collects, those are taxes payable. You haven't paid them yet, but let's hope that you're able to pay them soon in the future. Interest payable, that's on your loans. If you have a loan, you have to pay interest. If you have a line of credit that you've used, you have to pay interest on the amount. Warranty payable, if you in construction and you have issued a warranty to a client to let them know that if something wrong, you're going to cover X amount of dollars of the cost. That's a warranty liability. It's payable. You don't know when, but you have to have that money under your current liability so that you can cover it. Any type of unearned revenue is a liability. It's not earned. That means somebody paid you and you have not yet done the work that you were supposed to do to get paid. So those are the liabilities that exist that goes against your assets. Now that entire $6,100 of liability is due. The whole thing is due if they come back and say they want their money. But look on the asset side. What is it on the asset side that you are unable to turn into cash quickly? Because you have cash, you have petty cash, you have temporary investment. A temporary investment could be something like stock, bond, something that you can cash in. Those are the things that we're thinking about when we talk about temporary investments. What about accounts receivable? Those are people, those are the accounts for people who owe you. And you expect to be able to get your money back from them in the event that you need it. So we're going to leave accounts receivable there because you think they're going to pay you. So the accounts receivable is often, in most businesses, a very large balance. When I look at it, or when I used to look at it on a regular basis, I always wanted to see it over 30 days, 60, 90, 120. If anything went past 120, I still wanted to see how far beyond 120 days did it go. So at 30 days, 60 days, I want to know why is it that we still have that much money in accounts receivable outstanding. 90 days is a red flag. You're running into problems. It's harder to get your money. You have to ask the debtor. You have to ask the person who owes you, why aren't they able to pay you? You have to start sending letters. You have to start sending letters with an interest on it, because that's a free loan to them that's costing you money. When people owe you money and you're not charging them an interest equivalent to what the bank is charging you or what is customary, you are giving them free money. And sometimes they don't even pay you back. Meanwhile, you are still paying the bank whatever loans you have that you cannot pay because they owe you. That's the accounts receivable stuff. Then we have inventory and we have supplies. It's hard for you to get rid of inventory and supplies. Whenever you see a store closing, what does it say? We are closing, going out of business, sale, huge markdowns. So already that means all that inventory you have on your shelf, all that inventory you have on your book is really not worth much of anything when you go out of business. So you have to subtract your inventory from the total cash that you have. You have your total asset, current asset. You have to subtract your prepaid insurance. You already paid it. I'm pretty sure those people are not about to give you back that money because they already paid it on their end too. So you have to subtract prepaid insurance, any kind of prepaid bills from your current assets so that you can get your quick ratio. Again, your quick ratio measures your company ability to meet a short-term debt with its most liquid asset. So what are you looking for? When you take your total current assets, you subtract out away from it your inventory and your prepaid, you will notice that on my calculation, it says that the only thing you really have left in asset is $48,500. Now we're going to go to the computer ratio, okay? We want to know whether or not the company will have enough money to pay its bills, its payables. So we're going to take the current ratio, asset minus inventory and prepaid. So we're going to get the amounts that's actually available to pay the bill, which in this term, in this particular situation, is $48,500 and not $89,500 as you thought. So, and then we're going to divide it by the total current liabilities. So we're going to divide it by the total current liabilities right here. Okay? Oops, I'm sorry. And let's present from here. Okay, so we're going to take, let me move this thing out of my way because this is in my way. We're going to take the total current liabilities and divide it, the total current assets minus your inventory and your prepaid, and we're going to divide it by your total current liabilities. Now, here's what you need to know. If the answer you get is less than 1, that means you don't have enough money to pay your bill. That means for every liability you have, every $1 of liability, you only have 79.8 cents right here. You only have 79.8 cents or 0.798 cents for every dollar you owe. You cannot pay your bills. That means you will not be able to pay somebody here. You know you're going to have to pay the wages that they're going to take you to court. So normally what happens is that accounts payable kind of get hit. You tend to not pay that one as quickly. That means somebody else is waiting for you to pay them and you're unable to pay them. Okay, so current liabilities are what you owe. And if what you owe is more than what you have in cash, you're really not doing good. Please, if anything you do, always mention your company's ability to pay a short-term debt on a regular annual basis. On a monthly basis, either monthly basis or bi-weekly basis. Somebody should be looking at your current liabilities and your revenue each and every week or at least once a month to determine whether or not your company is able to meet a short-term debt. Gross profit margin. How much profit let's back up. Gross profit, not net profit. Gross profit looks at the higher end of the financial statement. It's looking at your sales, your revenue, what you call revenue, that total revenue on the higher line. And if you're shipping goods in, you're going to have costs associated with shipping in goods or shipping out goods. You're going to have costs that is associated with your direct employees. So if you are in construction, the employees that are working directly on the job site, that's going to be a cost that's associated with the goods that you're selling. If you have subcontractors, that's going to be a cost that's associated with goods that you're selling. Any cost that is associated with the goods that you're selling is referred to as cost of goods sold. So here we are going into a little bit more details to help you understand the financial statement. You have revenue. Right on the revenue, you have the cost of your goods sold, and that's how you get, and when you subtract your cost of goods sold from your revenue, you'll get your gross profit. And so what we're looking at is, now we're going to look at the margin or the ratio. And the gross profit ratio is usually expressed as a percentage of sale. I'm providing you with all these details so that you can look it over. I didn't want to give you just really large bullet points and then you're looking at my my handout like, okay, I don't know what this means. I don't know what that means. So instead of giving you pretty pictures and funny pictures to help cement the concept in your head, I wanted to give you the words that you can read through and understand. The cost of hiring, let's go back to this, the cost of hiring and mobilizing a new employee who will be working on a specific job site goes directly to cost of goods sold. If you're doing construction, your project manager may be in charge of several different jobs. You have to track the time that your project manager spends on each job so that you can allocate that cost as a direct cost to each job site and therefore directly into the cost of goods sold. Okay, so you have to track not just your expenses, but you have to track your expenses by the purpose. Like, why do you have this safety person? Do you just have them to kick rocks, or you have them to work on the Navy well wall, on the stadiums? Why do you have this person? How much time is this person spending on that project? You have to track all of these so that you can come up with an accurate cost of goods sold, okay? So that you can also come up with an accurate gross profit and then a gross profit margin. So that's how they all kind of fit into each other. You can't just look at your profit and say, let me find out what's the margin. You can't take your profit and subtract all of your expenses and say, this is my gross profit margin. You cannot do that. You have to take your gross profit, subtract out of it your cost of goods sold, and then you have your gross margin, okay? Your gross profit margin. I'm sorry, take your revenue, subtract out of it your cost of goods sold. Revenue, subtract cost of goods sold, gives you your gross profit. And now, in order to find the margin, you're going to take your revenue, the results of your revenue minus the cost of goods sold, plus the cost of labor. Cost of labor is the people who are working specifically on the job. Okay. You're going to minus any supplies that you bought to put on the job. Those are usually referred to as materials, job materials. You won't have them unless you had purchased them for a particular job. So you're going to subtract the materials, cost of goods sold, the materials, the cost of labor, certain overhead percentages, so that you can get the gross profit. Once you have the gross profit, or often called the net sales, you're going to take that figure and divide it by your revenue minus any returns, any allowances, and any discounts you've given. A lot of companies don't realize that the discounts that they give on their jobs are very important. It actually reduces your sale. So when you give somebody a $5 discount or 5% discount off of $100, that's a discount. You have to subtract that out from your revenue. You have to also create a line item for these discounts. If you give an allowance, you have to have a line item on your financial statement for allowances. And if you have any returns, you have to go back and adjust your sales figure by what was returned. So if we look at your gross profit margin, you have to take all these things into consider so that you can get a true cost of what was your sales, your real sales. What was your real sales during that period? Okay, you can't just do all this stuff, put it at the bottom in the regular expense section and expect to understand where your money is going. Because sometimes you thought you made a sale of 100,000, but between your returns, your allowances, and your discount, you only made a sale of 75,000. And if you're not tracking your returns, your allowances, and discount, that's another way you're losing money because you're not really tracking your true revenue. Okay, so let's go back and look at the last paragraph. Let's look on the right-hand side where it says gross margin is the revenue minus your cost of goods sold and your cost of labor and your inventory. You're going to subtract those three things from your revenue. Okay. And then you're going to you can call it net sales, you can call it gross profit, but the bottom line is you're going to divide it by your revenue minus those returns, your allowances, and your discount. That's your true revenue. So you're going to take your sales and divide it by your true revenue. Okay. And the answer that you get will be used to compute your gross profit margin. And of course, again, when we're talking about finding out ratios and percentages, you always got to multiply by 100 in order to get a percent. If you're tracking these percentage figures each month, you'll be able to see whether or not your net sales is increasing or decreasing. Even if you're tracking your returns, just your returns, your allowances, and your discount that you're giving each month, you'll be able to see whether or not you're giving too much of a discount, whether or not your discount is hindering your actual revenues, because you're reducing your revenue by your discount. And if you're giving all these discounts and you're not tracking how much discount you're giving, you won't realize that you're actually losing money because of those discounts. Sometimes it's not employee theft. People like to say your employees are stealing, your employees aren't paying attention to what they're doing. No, you're giving too much of a friend and family hookup to the people that you know. And so you need to track these returns, allowances, and discounts. I can't stop saying it. Track it so that you can know exactly how much money you are really and truly, how much money you really and truly are not earning. Because just because it's called a revenue and you made a sale of $100,000, remember, if you're not tracking the returns, the allowances, and discount, you will not know for sure whether or not your sales was really 100,000 or your sales was really 80,000 because of all these discounts and allowances and returns that took place throughout the period of time. If you need me to explain this some more, I'll be willing to explain it. But for now, we're going to move on to the operating margin. So we talked about up gross margin, because gross margin is really measuring our profit. You know, where's your profit coming from? What's impacting it? What adjustments can you make on that higher end of the financial statement so that you have enough money to really to measure and control your operating expenses. What is operating expenses? The rent that you pay on your building, the gasoline that you use in your car that you cannot apply directly to any project, okay? Depreciation, which is not really real money, but it's a benefit to you as a business to be able to take depreciation on your equipment, especially if you take it, well, if you're doing accruals versus cash, there are two different ways of doing it. I'm not going to go into that right now, but operating expenses such as supplies that you need just to run your office, the administrative assistant that you need in your office to help keep track of what you're not doing very well. The other employees that you have, the time that your employees are not dedicating towards a specific project now comes on the operating expense, electricity, water, just the general things of whether or not you're making money, you still have to pay. Those are operating expenses. Now, when you study operating expenses, you are looking to see how well your company is managing costs. When you are looking at your operating expenses, you're trying to measure how well your company is managing costs. And there are different types of costs that goes along with your expenses. You have variable costs, things that changes due to quantity, and you have fixed costs, things that will not change at all. So your rent is a fixed cost, but your electricity bill is a variable cost because it's going to change depending on whether or not you left the lights on last night. Okay, you may buy a specific set of supplies that you need. Okay, that's an operating expense. However, the fixed supplies such as maybe a fax machine or something, because it's mine, it's an asset, but it's so small you can write it off as an expense. That fixed supply needs paper. That's a variable expense. Okay, it's going to change based upon usage. So let's go back over looking at your operating margin. We're not just looking at the higher level expenses that we can assign to a actual revenue generating center. We're looking at all of the other expenses that don't fall into that category, but you need it in order for your company to continue to grow. Okay. How do you compute this operating expense? So remember cost of goods sold, we talked about it over here. Those are the costs that can be directly associated with the revenue generation of your business. Direct association is the labor that had to go out on the construction site. The guy who has to go and tow the vehicle because you run a towing company. The trucker who has to run a load because he got to get the load from the Port of New Orleans to Baton Rouge or further. Those are direct costs, okay? So you have to add the cost of goods sold to the operating expenses. We're only looking at expenses, only your expenses. And then you're going to divide it by your total revenue, what you earned. That's what you're going to divide it by. Because if that number comes in high, okay, it tells us that the company is being managed well. Okay. If the margins are low, it means that your company is at risk. And I had actually meant to put a formula there and I did not do it. So when I fix this slide, because I noticed a couple errors on it, when I fix this slide, I will definitely put in an example so that you can actually see where this money is coming from, but how the company is affected from an actual financial statement point of view. However, I did not want to extend this beyond the hour. I didn't want to extend it beyond the hour. So are you there yet? Are you at the point where you think your business is profitable? Is your business profitable? Have you given any consideration to any of these things? Is this the first time you've ever heard of any of these things? Would you like to understand it better? I don't want to leave you confused. So my name is Bonita Rice, and I'm available to help you understand it better. So, but I'm bringing this to you so that you can ask your bookkeeper, you can ask your accountant to not just only give you these numbers, but to explain to you what these numbers actually mean when we're comparing or talking about your business, when we're talking about the steps that you need to take in order to actually have a healthier bottom line, where you're actually showing your revenue. That's what we want to talk about. That's the conversation that you want to generate when you sit with your bookkeeper. Don't let somebody just email you your financial statement. Have a meeting with them, an hour meeting here. Meet with them on a regular basis. You know, it's definitely worth the money. And if they can't do it, then find an analyst who can sit and take their numbers, look at it, and explain it to you. Explain it to you in a way that you can understand it, in a way that you can apply it to make decisions. And that is what I did with those numbers when I worked in the corporate world. I did a lot of explaining. I think Lucille Ball, I believe, is the one who would say, you have lots of explaining to do, mister. I think it's her. If I'm wrong, then forgive me. But if you have any questions, again, please let me know. My name is Bonita Rice, and my information is readily available. But my goal is to see companies grow and prosper, and to help them to understand that their business is more than just the activity, but it's very much the numbers. Thank you so much, and have a wonderful day.